right, so I don't know where everyone is at as far as the understanding of the Fed, how it affects monetary policy when it comes to housing, real estate, and mortgage, but it's something that I have my finger on the pulse of since 2005. So VJ and I commonly talk about the Fed, what they're doing, how it's affecting real estate, mortgage rates, and all that, and the flow of money overall. So really quickly, the idea of tapering is actually a response to the initial catalyst, which was they stepped into the market to buy billions of dollars a month of bonds. Now, you probably heard this, started back in 2020. They're buying $120 billion a month of bonds. Well, 80 billion of that is in mortgage-backed securities, which are exactly what they sound like. They're mortgage-backed securities. So it's a security that is backed by mortgages, which are paid by people who own homes. So when this happens and the Fed injects $80 billion of money monthly into buying these securities, it creates more, supply and demand. So it creates more supply of money. And when there's more of something, it's cheaper to buy or it's cheaper to sell. So in this case, when there's $80 billion a month more than there normally is, rates go low because when there's a lot of supply, price is cheaper. That's why mortgage rates have been low for so long. Now, the Fed doesn't give loans. The marketplace doesn't give loans. Banks give loans. So it's still up to the banks to approve and deny people. It's up for banks to set a competitive rate and a price so that consumers will secure a loan with Chase or Wells Fargo or whoever it is. Now, the issue with tapering is that tapering is then stepping back out of those monthly commitments. But the problem is what happens is they're also handing off all of the risk back onto the open marketplace, on the private investors, hedge funds, and groups that buy mortgage-backed securities and banks that have them. So then what happens is if the risk increases to those banks and to those agencies, then they're going to mark rates up higher, which then makes the borrowing cost of that money for a $500,000 loan or $1 million loan more expensive to the consumer. Now, we're already facing inflation on like almost every single measurement you can make in the marketplace. And when it comes to housing, you are now facing the fact of the Fed saying we're going to start tapering back our monthly commitment of 80 billion, even if it goes down to 70 billion or 60 billion. You know, we can talk about those numbers super casually because it's not our money, but that's a lot of money they're taking back out of their participation to hand over all that risk back to the open market. The market is going to price that risk in, which means the cost of borrowing money is going to go high. What happens when the cost of money the cost to borrow money goes high? Prices have to go lower. So part of the price increase you've seen is people overbidding on homes, but the cost to borrow the money to buy that home has been less. So does that mean there's going to be a crash? No, because there won't be a flash crash, number one. Number two, you already are having an affordability crunch, and you see that in the reduction of the amount of mortgage applications. That's a measurement too, and that's been declining slowly. But you're also faced that with the other careening train wreck, which is the eviction and mortgage foreclosure moratoriums that have been lifted. So now you have all these competing variables that are like careening towards each other, where there's the prospect of the cost of money increasing over time to borrow money in the housing market, as well as the same time you have people that are about to become foreclosed because the eviction moratorium is over, or their renters that are going to be evicted, or their mortgage, they're going to foreclose on their house because they defaulted on their payments. And then you have the general lack of affordability because everything's more expensive for everybody. So families on fixed income or hourly payment or salary jobs, you know, and if they're dealing with a certain brick of money every month and everything becomes more expensive, they become less and less capable of keeping up with their bills and their expenses. So that's why you see consumer confidence going down, and the Fed's targeted inflation rate was 2%. They've overshot that like monthly. That was like their stated goal for the long term, and they're hitting it like every week. It's crazy. So anyways, tapering will increase rates, but at the same time, you can't have an economy increase rates when there are already people that are working. And if you're not working, you can't buy a house because you don't have a job to back up your ability to repay. It's hard to rent if you don't have good credit and you don't have work and the ability to repay your rent. So we have a little bit of an issue going on where there's competing factors, just technically speaking, and something's going to have to give. Not to mention that we're up against the debt ceiling, which has to be increased. And if not increased, then we're going to have a shutdown of the government. And then the only way to avoid that is to increase the debt ceiling and then try to pass more spending, which is what this, $3.5 trillion spending package is all about. So there's a quick recap. That's where we're at right now.
Yeah. So now pretty much what we got to this point just by understanding some of those micro fundamentals are being put together, right? We saw numbers coming out with PMI, we saw those numbers coming out with CPI, we saw the sentiment or the macro fundamentals being, released around tapering, all the market sentiment, all the sentiment even of officials from the central bank. But now you start to see this picture that's trying to be like painted of them talking about, well, we're getting a little bit better, or like what we're doing here is to pretty much help the economy, when in reality, that's not really what's happening. So when you're reading these things, like, try to read between the lines of what's going on. The goal isn't to understand every single detail, but the goal is to be able to put all this information together to understand the bigger picture. Exactly how you explained it, Andy.
One quick point about that, because when I'm gonna give an example, a primary example you can all touch, all politics aside, when the people at the podium are saying that they've added 750,000 jobs a month back into the economy, those are jobs that already pre-existed. So that's like saying, oh, well, I was holding his head underwater 10 feet, but I've now raised his head 10 feet up. Like, well, okay, now it's back at neutral. So it's not that that's a net plus jobs. That's just repositioning people into jobs that already existed that they didn't have. And that is also complemented and confirmed by the fact that you still have, a lot of jobs that are open, like 10.4 came out that there's like 10.9 million jobs available. They're going unfilled. So those are, the JOLTS report was not that high 6 months ago, 10 months ago, 12 months ago, 18 months ago. So all they're doing is refilling the hole. They're not actually building a mountain. Does that make sense?
Yeah, does anyone have any questions about that? That was definitely a lot of information. I'm pretty sure.
Sorry, it's recorded.
Yeah, it's recorded, so you get to go back and you get to hear it a couple of times. But that's the rippling effect that's happening in the economy. And it's just not in the US, it's in every major economy, right? Everything in the past year and a half, ever since the pandemic started, we saw things happening in the UK. And then just a couple of weeks after that, we saw it happening in the US. And then we see like this rippling effect across all the other economies, right? And now we were talking specifically about the US here, what Andy was going over, but you're going to see the same exact thing across economies. So it's not just, just for the US. And that's the whole point. Understand like what's happening, what's the overall picture. And that's what Andy is painting here, right? That's why we see the confidence levels dropping down. It's not all of a sudden, right? There's nothing that was, pretty much hidden or that just happened out of the blue. These were things that were expected as we start to see like progressions and all these macro fundamentals are coming out, especially with the speeches where they're talking about, we're going to start thinking about tapering now. A bunch of other central bank officials are already saying taper now, taper now. But also you have to understand exactly what Andy said, with tapering comes with, its consequences. Jobs have opened up, but people are still not going back to work, right? Those jobs are still vacant. So when they say, for example, the last time we had employment data coming out, we didn't see a huge jump. And that's because
it was a huge miss.
Yeah, and that's because there were already jobs that were opened up and that are still vacant. People are not going and applying for those jobs or even getting hired or anything like that. If you already have a huge supply of jobs opened up, why would you keep adding more, right? If it's not being fulfilled already. So that was something that was already expected where, from the past couple of months, we already had jobs opening up. And again, those are not new jobs added to the economy. Those jobs were already there. Now you're starting to see all those, jobs being reintroduced into the economy as things start to open up a bit more. That's all that's really happening. So being able to understand what's really happening versus what's the market sentiment that's being put out. The market sentiment around that was that we have more jobs opening up. It's great for the economy. We're doing fantastic. It's a growth economy, this and that. And then a couple of weeks after that, what do you see happening? Those job numbers being missed, right?
Yeah. And you look at the GDP number too that I was texting you the other day about how like for the third quarter it's like in decline and it just keeps going, and then now all of a sudden they announce they're going to stop doing it. Like what, they're going to stop measuring it now? Okay, that's interesting because is that because you expect it to get worse? Like, I'm not trying to be conspiratorial, however, like if it's not functioning and your formula is being just blown up by the mechanics and the technicals, of course they're going to stop measuring it because they have no good news to report, and that's not a good sign.
Yeah, so you got to understand, as a government, as a major institution, I guess you could call them, like the central banks, if you don't have anything good to report, people are going to perceive it as a negative thing. So you could honestly just not report anything, and in the eyes of investors, they're just going to look at it as a negative way, where they're going to think that it's not any growth happening, right? And that's a negative thing in the market. So they're always going to find ways around it, and that's what we have to understand when we're reading all these fundamentals, when we're looking at the micro fundamentals that are coming out every single week throughout the week and putting them together. Again, the point is not to memorize every single detail, but to understand and put it together with the macro fundamentals and understand what's happening in the economy and how is that being reflected in the price. Because we went through this so many times in our webinars that fundamentals are the drivers of the markets, right? Fundamentals is the driver, and then you have the technical analysis that visually represents what's happening fundamentally onto the charts, along with the market sentiment. So that was a quick, couple of minutes of review of what's happening from a macro fundamental perspective. And now we're just going to go through the articles. Now you guys are pretty much ready to understand what's happening in these articles. So I'm not going to spend too much time on them, but we're just trying to understand what's the market sentiment like here. So any questions before we move on first? Someone said need to go over this. Yeah, that was definitely a lot of information.
Is it okay if I share the Nowcast model on the chat for everybody?
Yeah,
what I sent you? Okay.
Yeah, go for it.
All right, thanks.
No, I'm good.
All right, awesome. So actually, I'll pull up the model here too. So this is the model that Andy shared with me, and this is what we're talking about going over this. Right, where there's the suspension notification that they're talking about, and then you have, April, July, August, all of these nowcasts that are being put out and released, and understand the data, what's actually happening here, right? This is from the Federal Reserve Bank of New York, suspends their modeling. There you go. This is the visual representation of what Andy was just talking about. So he just put that into the chat. Feel free to, take a look.
I wish I could find it. If I can find it, I'll double back in Discord and send this to everybody. I also saw somewhere else that they're going to start stripping out certain things that are causing the inflation number to be inappropriately high, but they're still in the marketplace. Like they're saying, I think it was like meat and a couple of other like hard goods, and they're like, well, that's skewing our numbers. Like, well, that's what the consumer's really paying. But now they're going to remove it just so the number looks more docile.
But that's data manipulation.
That's
it doesn't really change.
That's what I'm playing. That's what I'm saying. It's manipulation. It doesn't change it when I go to the store and I buy the normal stuff I buy plus ground beef. You can't just take that out of the equation because it's still affecting the consumer at the checkout lane.
Absolutely. So it doesn't really change anything in the picture. But yeah, so the Fed is seen on track for 2021 taper start even as COVID-19 swirls. So we know that the cases are starting to increase, or at least that's what's being released, that cases related to the Delta variant are increasing, not just in the US, but in Japan and the UK and all of that. But now, again, we've reiterated this so many times in our past, weekly outlooks for the past couple of months. The cases are going to increase, right? As you have new variants coming out, the cases will increase. The more important thing is, as a government, how do you handle that? The cases are going to increase. There's always going to be new variants coming out. There's always going to be like a new virus or a new disease. But how do you as a government handle that and make sure that you don't go into another lockdown? As cases are increasing, you could taper, you could do all of that. But again, it's going to have its consequences, right? You could taper, you could pull that money back. Like Andy's saying, from 80 billion to like 70 billion, to us, it doesn't sound much, but that's still a lot of money that's being pulled out of the economy, right? And then what about all those people that are going to be affected by it? In every single central bank statement that we've heard or speech that we've heard, they've always talked about, special minority groups that they're hoping that the numbers are going to increase. And once they start seeing growth in that, that's when they're going to start tapering. But as soon as you taper, those are the groups that are going to be affected the most and first. So then how do you handle that, right? So now what we're starting to see is that the Federal Reserve is unlikely to announce a start date to scaling back asset purchases at its meeting this month, but it's still on track to begin in 2021. We've already talked about this, how they're not going to be increasing interest rates for sure until the next year or the year after that. But before they do that, they have to taper. So if they're going to keep pushing back tapering, until the end of 2021 or the beginning of 2022, you're not going to see increased interest rates until many months after that. And those are the small baby steps that you have to take in order to make sure that your economy is not going into like a hyperinflation. And that's what the next article is going to be about, because I found that very interesting how a former official was drawing parallels between what happened in 1970 and what's happening right now. Take that with a grain of salt. That doesn't necessarily mean everything is true, but understand what are the parallels there that are being put into place right now.
Just a quick comment. I put it in the chat too. Stagflation is also an option here. It's not just that there's no inflation, or hyperinflation. Stagflation might be something that happens as well. So just be aware of that.
Yeah. And so this past NFP that came out, the investors, they were already expecting, and along with central bank officials in general, they weren't expecting NFP to really change the view on anything. And that's what's stated here. I don't think the August employment report has changed my view. And that's what the Fed president from Cleveland is saying. And that's because, again, jobs were already opening up in the past couple of months. And so they were not going to continue adding jobs until those jobs are already filled, right? At least 50% or more of them. And so that's why the sentiment already leading up to NFP. In the past NFP, we've seen a lot of volume kicking in. This last one, we didn't, not as much as the previous ones, right? And so that's the sentiment that was already leading up to NFP, where they were already expecting nothing to change. Because they knew that nothing in the economy itself is changing for the reasons that already were discussed earlier. September 21st and 22nd, you want to be paying really close attention to those. Those are going to be the important macro fundamentals that we will be looking at as a group and trading as well. Leading up to that was the market sentiment. And that's when FOMC is going to come together and could signal tapering at its meeting in early November. So again, these are just market sentiments that are being put out through these speeches. They're not saying that they are going to taper, they're saying that they could be tapering. So those are some of the keywords that you want to be paying attention to. So they could be tapering at its meeting in early November, but again, as we get closer to November, they could continue to say that, hey, we don't think the economy is just ready for it yet, but we're still discussing it. And then they could push it from November to December or even next year. But the point being is interest rates, which are the key tool that the central bank has to fight against inflation, those interest rates will not be increasing many months after tapering has begun. So this is pretty much like all the stuff that we've already talked about, right? Even right now, all the stuff that we've talked about in our past weekly outlooks, and these are just kind of going into detail, and they're expecting language from the Fed meeting that leans November for tapering, but does not lock November. So again, all of this is pretty much putting out an investor in a market sentiment, right? That's leading up those expectations going up to the September meeting and then looking for hints. So as we get closer to September 21st and 22nd, it's very important to understand that we could see consolidation in markets again. We could see volatility in markets again as we lead up to those important dates, what investors are waiting for. That is also an important date for Japan as well, because that's when the Japanese interest rates will be coming out. So the deputy governor from Japan already came out and said that because of the economy going back into a state of emergency, Japan going back into a state of emergency, rather, because of that, he does not think that Japan is just yet ready for a growth economy. They're not ready to taper. They're not ready to increase interest rates either. And he is supporting the accommodative stance, which is pretty much keep putting money into the economy until it's able to stand on its 2 feet. But the key thing here to note is we did the same exact thing in the US a couple of months ago. Right? So now the key thing to note is, are we going to see the same exact thing happening in Japan? 2 different economies, 2 different countries, 2 different central banks, but we've seen that rippling effect of some different variations happening across economies. And so that's what we want to be watching out for as we're going towards the closer to September. Also, another key thing to note is this is the last month of this quarter. A new quarter will be starting next month. And so you want to be very careful as you're looking for trade opportunities, paying really close attention to some of those higher time frame levels, which we will be going through in our technical analysis here. But yeah, the resurgence of coronavirus cases and hospitalization in the US has damped some economic activity, including hiring. Hint, hint, employment data right there, right? This last thing, we've been seeing that for how many months, right? So really in the economy, it's not all, like we said, like glitters and unicorns as they were making it sound. And it's not like that right now either. So just understand what's happening and what does that essentially mean for the dollar, and even just safe haven currencies in general and risk currencies. There's not as much optimism as they're trying to put out when you actually look at the economy and what's happening in the economy. So I'm not trying to scare off anyone, but that's pretty much what's going on here. And then you could just continue down and continue to read a lot of different sentiments from different officials of the central bank. But tapering is off the table this month. Whether the Fed will make an announcement before year end depends on the strength of employment, and we know that's going to take a couple of months. So it's definitely not happening this year. Especially the strength that they're talking about, that's not going to happen this year. And I want to share this as well. This was the one where they were pulling parallels between the high inflation era. So we're not going to go through every single thing, but again, Summers here, who is the former Treasury Secretary, is saying that I don't think we're anywhere close to the kind of Carter era double-digit inflation, but I do think we're in a very serious danger of repeating almost all the mistakes of the 1960s and 70s. And this is where he starts to pull the parallels here, just a couple of them, but again, take this with a grain of salt, right? So everything that he's saying does not mean that we're headed for hyperinflation or anything like that, but try to understand what's the different sentiments that are being put out, right? So the Federal Reserve increasingly talking about social objectives, the increase of social protests, a White House trying to deliver progressive social and economic policies, and the withdrawal from Afghanistan. And then as you continue down, you're going to see the same exact thing. The next week's Consumer Price Index report is forecast to show a 0.4% advance in the CPI. And this comes right back to what Andy said earlier about you could pull out all these different factors from your model or from your formula, but it doesn't really change what's really happening on the ground, which is consumers are paying a lot more money than they should be paying for a lot of different things. So he went over through the consumer side of the economy. He went through the real estate. He's in the mortgage industry. So he talked about that as well, how that's being affected. So you're starting to see that rippling effect. So I'm just going to briefly go over those, but you can go through the entire article as well. We pretty much summarized it in the beginning, which I guess was a good thing. And then Biden's sweeping vaccine mandate stopped short of domestic flyers. So this week, Joe Biden announced to get more Americans vaccinated. One high-profile move was missing, requiring vaccines or negative tests to get on an airplane. That's quite interesting. So we know that the airline industry, the tourism industry in general, across economies, has been hit very hard, right? And we have seen certain airlines getting money, getting bailouts, even on the low, so many times, not in just the US, but in the UK as well, right? And so this is very interesting because countries including France, Italy, and Canada have imposed requirements or will impose the requirements for domestic travel as a way to slow the spread of coronavirus and its emerging variants. But the interesting part for me here was that the US still only requires a mask for domestic flights, despite calls from some health experts to raise the bar and require proof of vaccines or a negative test. Biden stopped short of tightening the rules when he unveiled a new series of vaccine mandates on Thursday that will affect millions of federal and healthcare workers, as well as vaccine or testing requirements for any business with 100 or more staff. So pretty much what he did in this was that he's requiring businesses to require their employees to have vaccines or get tested regularly, right? But again, you have a higher chance of probably contracting that virus from just by sitting next to someone for 10, 12 hours on an international flight, right? And all they're doing is just requiring a mask. You could require the same thing at workplaces, but now they're requiring vaccines, or they're saying go get tested regularly. So this was very interesting because this could be one way of pretty much helping the airline industry, because if you start forcing people like you have to get a vaccine or you have to show us a negative test, a lot of people, we already know that from the last year since the pandemic started, when they started putting out these requirements, a lot of people had just stopped traveling, right? Because it was first a quarantine thing. A lot of people, they're like, I don't want to travel if I have to quarantine for 14 days. A lot of people said, I don't want to travel if I have to keep taking a COVID test, right? And a lot of people stopped traveling because they just did not feel comfortable or confident in the vaccines.
This is to help keep money flowing through the airlines. The government already gave the airline industry billions of dollars so that they didn't have to do layoffs. And
Yeah.
so they're not going to impose that on them because that would be restrictive to the flow of money coming into the airlines that they've already put a backstop behind.
Yep. So there you go. Right. So that's just another way of keeping the money flowing into that industry where they've already put so much money in. Instead, what they're doing is they double the fines for people who refuse to wear a mask on planes. That's not going to stop the virus to spread if you're sitting right next to someone.
And people that have ungodly amounts of money don't care.
Exactly. So that's pretty much what we're seeing from the airline industry side. So I hope you guys are able to understand what's happening from, the central bank side. And then now this is just one example, which is the airline industry. And then plus on top of that, we got another example from like the mortgage side and then the consumer side. So I hope you guys are able to put together like what's the overall economic picture. Next up is UK's economy. Coronavirus rebound grinds to a halt in July. So cases still increasing. Like we said earlier, it's not just the US, but cases are increasing across the world. The UK economy barely grew in July, suggesting the recovery from the coronavirus recession is rapidly leveling off as consumer spending weakens and supply disruptions hamper production. So we already know if you look at from global economy perspective, you have the tensions, the geopolitical tensions, right, with the withdrawal from Afghanistan. You have the global supply chain that started slowing down, started off from China, had a rippling effect through all the other major economies. Now you're starting to look at individual economies. So we saw in the US, you have inflation that's already going on because of the lockdown that happened. On top of that, you add the global supply chain slowing down, and that itself is also going to increase the prices because simple supply and demand. Supply chain starts to slow down. That means there's less supply of goods coming in to an economy, right? And how do you compensate for that? You start increasing prices, right? Simple supply and demand. If there's high demand, low supply, you're going to see a high price. Plus part of the announcement yesterday was about increasing testing. Yeah. Increasing testing and then also trying to vaccinate more people. That's how you do it, right? You tell them we're going to start increasing testing. Then people are like, well, I don't want to keep getting tested. And that's how you force them to go get vaccinated. But yeah, so that's pretty much what you're starting to see in the economies where all these other different things are playing together to finally increase that inflation. And then how do you fight against inflation? Increase the interest rates. How do you increase the interest rates? You have to taper. How do you taper? You need to see all this growth happening. And if you don't see the growth happening, what do? You force it. You force that to happen, but obviously you can't continue doing that because it's going to have a much more negative effect or much more negative consequence. So really all we're doing is coming back to square one.
Yeah. Do you remember a couple, maybe it's a quarter or 2 quarters ago, we talked about the M2 money supply. We didn't talk about it here, but we're talking about how when stimulus came back out again, there was a steep drop in the amount of consumer debt owed on personal credit, and there was a steep increase of personal money on hand in savings accounts, which is the M2 money supply. So if you're ever curious about that, you can go to the St. Louis Fed, you look up the M1 and M2 money supply. M2 money supply is personal savings, and you see that within 30, 60, 90 days of stimulus going in, personal credit card debt balances owed declined and personal savings increased.
Yep.
So we gave money to stimulate the economy, some of which was spent, some of it was just to pay down debt, and a lot of it went to increase personal savings. Yep.
So now, again, the bigger picture, and now you're starting to see like individual components coming together to build that bigger picture. And then another thing that I wanted to go over in this article here was the loss of momentum in July when the economy completed its reopening also reflects the concerns about the spread of the Delta variant, because when the economy was opening, one of the major concerns from the employment side or the labor market side was that people who are working in public facing sectors didn't want to go back. They didn't feel comfortable going back as the cases were already increasing. The UK government, as a federal, on a federal level, did was remove the mandates, right? The social distancing, this and that. But then on the ground levels, like in London, for example, in all these different areas, those governors, mayors, they started stepping in and they started talking about like, if you're going to travel on public transportation in London, you need to have a mask on and you need to socially distance, right? And they were enforcing that through enforcement officers, placing them like on, the railway stations or the bus stops and things like that. But now the momentum obviously started to slow down because people, they were not feeling comfortable working in those public facing sectors, which in turn obviously affects the employment side or the labor market overall. And that all came from the concerns of the spread of the Delta variant and a requirement for hundreds of thousands of people to stay at home after being pinged by a National Health Service contact tracing app. So we saw obviously the pound started to increase just because of the sentiment of traders more focused on the outlook for Bank of England. As an investor, your primary focus is not, what already happened. You're going to use what happened. You're going to use what's happening right now to understand what's the outlook for this economy, right? It's the same exact thing when you go invest in a company, right? If you go invest in Apple, for example, yeah, they've already introduced all these iPhones and MacBooks and all this stuff. But when you're investing in Apple, you're investing because of the outlook you have for that company, right? You're expecting the stock prices to increase for what reason? Because you think the company is going to do well. When you go and invest into an economy, you're not investing because what's happening right now. You're investing because you think the pound is going to do much better in relative to the yen, right? And that's why you go on a buy position for GBP, JPY. And so that's what this is saying here. That's a sign that traders are more focused on the outlook for the Bank of England. And in testimony to Parliament this week, Governor Bailey acknowledged growth was plateauing, but reiterated it was reasonable to expect rate hikes would come in coming years. But again, what does that essentially mean? You've already put so much money into the economy. Before you increase the interest rates, you have to taper. And if you're going to taper, you need to see the growth, economic growth increasing, right? Instead of plateauing. That is not what you want. You don't want a plateaued growth if you're going to start talking about tapering. And then you go into increased interest rates. So as of right now, we're seeing the same exact thing in the UK economy, right? We're not seeing that economic growth, but what do we look at? The optimism is coming from the fact that UK was the first economy to open up without any federal restrictions, whereas on the other hand, Biden is just adding the mandates, right? UK was also the first for mass vaccination, whereas in the US, we're still working towards that. We have a good number of people vaccinated, but we still need to work towards vaccinating a majority of Americans. So that's where that market sentiment is coming in, that optimism that we've been seeing from a technical perspective for the pound pairs, many of the pound pairs, that's where that optimism is coming from. And then you have details about consumer-facing services, fell by 0.3% in July, largely due a 2.5% fall in retail sales. Again, public-facing sectors and those jobs are not being filled completely yet because of concerns around the Delta variant. More difficulties lie ahead with several support programs put in place to help people through the crisis due to come to an end this month. So same exact thing. There was like a furlough plan by the government, which is supporting millions of people. And then there's like welfare benefits. There's like all these different programs, same thing in the US, unemployment benefits. You also had a program which pretty much told landlords that they weren't able to evict people because of the pandemic. All of that is coming to an end shortly, but if obviously things start to increase or get worse, which they already are, they're going to keep increasing these benefits. Let's start off from the 12th to the 17th. So Sunday market opened quite easy, not much going on here besides the Japanese yen PPI, which is a producer's price index. Again, that is one factor that kind of gouges inflation, but from the producer's perspective. To reiterate how this kind of works with PPI, RPI, and CPI is that if the producer obviously has to get raw material in order to produce their product, right? If that raw material that they're getting already that needs to go into building their product is expensive. Let's say, Andy is the producer, right? And I'm the retail side and you guys are the consumer side. Andy has to build his product. Let's say I have, a pen here. So let's say Andy has to build a pen, make a pen. He needs to, get the plastic. He needs to get like this little rubber thing for his pen, ink, all that stuff, the spraying. Let's say all that to put together maybe cost him $2. In order for him to make profit on whatever he just made, he needs to sell that to me for $3, $4, $5. Let's say he sells a pen to me, let's say around for $4. He just made a $2 profit. In order for me to make a profit on that, I need to sell it to you guys, the consumers, for $5, $6, $7. Let's say I sell it to you for $7, right? And now you think, okay, it's reasonable. For whatever reason, you think a pen is worth $7. Okay, let's go with that. And now let's say things start to get more expensive. Inflation's coming into play. Let's say the plastic or the spring and the rubber that Andy needed to make this pen was coming from China. We know that there's already a global supply chain disruption going on, and all of like his products or shipping is getting delayed. So he only has a limited amount of supply to work with, right? So he's gonna, instead of selling that pen to me that, you know, cost him $2 to make, instead of selling it to me for $4, he sells it to me for $6, right? Because he needs to obviously get that capital. Supply is low. I have a high demand. I'm coming to him telling Andy, I need these many pens because I have consumers waiting for this, right? So he just made a higher profit. In order for me to make profit on a pen that he just sold to me for a higher price, I need to sell it to you, the consumers, for even higher, right? And then make that profit. So now you're paying almost, you know, 4, 5, 6, 7 times of whatever Andy paid or to make this pen. That's inflation in a nutshell.
And to your point, this is when we start looking at buyer behavior. When you start seeing buyers stop spending money in periphery services or periphery products, you can start sensing that that is hitting the bottom line of the person at their own checkbook. And it goes all the way to the dirt in the ground, to that tractor, or that, like, not tractor, but you know, that backhoe that pulls that dirt out and then puts it in the truck, and that truck that takes it to the factory that spits out that, it goes all the way down to the source, and it ends up on your debit card swiping for that pen. And when people start thinking twice, thinking even 3 times, well, should I do this? Should I not? Now you know you're at a pivotal point where things are going to start turning.
Yep. There you go. And so that's what PPI is for, right? So when you look at Sunday, when the market opens up and you see the Japanese yen PPI coming out, understanding as this number starts to increase, actual greater than forecast is good for currency is the change in price of goods sold by corporations. It's a leading indicator of consumer inflation. Yes, this is good when you're sitting at rock bottom of your economy, but it's not the best when you're sitting at a peak. So that's what you have to understand. If there's already so much inflation that there's concerns going around about it, and I don't mean it just for the yen, but also for the dollar and for the pound and all these other currencies, if there's already so much inflation that there's concerns about going around about it, you want to think twice about what does that PPI increase mean, really, right? And it doesn't mean the best thing at the moment.
Can I draw a real quick correlation to just put all these pieces together? Now, you know, BJ's saying that everything gets more expensive, right? Now, if everything gets more expensive, that will cause people who are already on the fringe of financial hardship to rely on the government more. And that may be what they want. If they have to rely on the government more, and there's more people that need monthly aid for everything, that means the government has to expand its budget. And then in order to expand their budget, they have to get approval for that. This is exactly why we're at a roadblock, because it's being the inflation that's being allowed to run red hot over here is causing the problem. That means the debt ceiling either has to go up or we're at an impasse. So this is, the next couple of weeks are going to be really critical. Watch what they're saying out of the Senate, out of Washington, D.C., because this will tell you whether they're going to actually be able to do something about it or not.
And the chances are not really.
The chances are not really. And then that just means it's bad because people are still going to be fending for themselves.
Yeah.
Unless there's more money to help them with. And having more money comes at the expense of more taxes, because that's how the money gets there to begin with. Everything is taxpayer funded, not government funded. They don't have the money until you pay the tax first.
There you go. And that's why the consumer is the core of the economy. So then moving on, not much coming out on Monday, especially in the New York session. You have the federal budget balance. Given everything that we're talking about, this is probably something that's gonna be of interest, and you probably should take a look at it. But again, you don't need to know the details exactly of like negative 302.1 versus like negative 260, you know, just kind of understand the gist of it, of what's going on. Are things getting better really, or are they getting worse? And by the looks of it, I'll let you guys make that judgment.
Expand the graph and show everybody on the screen.
This one right here. Yeah.
Yeah,
so really,
look at it. Yeah. Look at it since 2020 when the pandemic hit.
So what does that really tell you? you're sitting at one point in July 2020, we're sitting at negative 882.3 billion.
Yeah, the best it's been in the last 12 months was August of 2020. And that was negative 87 billion.
Yeah, there you go. So these are minor things that you want to be taking a look at to kind of understand what's really going on here. And then on Monday, pre-London session, this is something that you want to be paying attention to, the claimant count change and unemployment rate. I really hope you guys are able to understand now why this is important, given everything that we just discussed for like the past 30 minutes, 40 minutes. But this is a change in the number of people claiming unemployment related benefits during the previous month. It's about 16 days after the month ends, so it's pretty relevant data that you want to be paying attention to. And these are things that these are things that do come together and they make up those monetary policies or those interest rates. They make up those speeches that people or these central bank officials are talking about. This is what they're looking at, unemployment rate. And then Tuesday, you have CPI data coming out. So needless to say why you need to be paying attention to that. We just talked about it with the whole pen example and everything. So core CPI, you want to pay attention to CPI as well. So this is the change in the price of goods and services purchased by consumers. And then this is excluding food and energy. And then as we continue down, again, you have a pretty good pre-London session setting up for you, which is CPI data coming out, core CPI, PPI, and RPI. This is pretty much my favorite fundamental because you get to see all three of them together, right? But obviously this is more like the leading indicator of everything else. So PPI, which is about 15 days after the month ends, this is a change in the price of goods and raw materials purchased by manufacturers, right? And then this is how much they're paying in order to make a pen. This is how much they're paying for that rubber, that plastic, and that spring and everything like that. And then the output is how much did it cost them to actually build this pen. So yeah, you paid for the input, but now you have to pay for the labor too, right? And then how much does it cost, all of those costs included of actually being able to make this pen. That's your output right there. So sold by manufacturers. How much did I pay for the raw materials? And then how much did it cost me to make it? And then how much am I going to sell it to Andy or to you guys? And then you have RPI, which is a retail side. So this is purchased by consumers for the purpose of consumption. So how much are you paying, or how much is a retail side paying for this pen, and then passing that price on to the consumer side, which is the CPI data here. And then Wednesday, you have pretty chill New York session where you have Empire State Manufacturing Index coming out, import prices, industrial production. So you have some USD data coming out, but it's a chill session, so there's not much going on here. And then, of course, if you're trading USD CAD or oil, you're going to pay attention to crude oil inventories. And then Thursday is where you have some of the more important data coming out, where you in New York session where you have core retail sales, and then unemployment claims like every week. And then Friday, or actually, yeah, pre-London session, you have GBP data coming out, which is retail sales. And then on Friday, consumer sentiment and inflation expectations. All right, cool. So then let's start off with gold today. We're going to start off with the yearly time frame. So 3 levels that I'm always going to mark off for gold here is going to be that 1680, which we tapped into a couple of times this year already. And then the next thing is going to be this top wick right here, which is the 1800 level. And then finally 1900, which is that resistance, 1900 right here. Yeah, if you guys have any questions, go ahead and feel free to put into the chat. So those are the 3 levels I'm going to mark off on the yearly time frame, and then we're going to drop down to the quarterly and start making zones here. And you can adjust these zones as you drop down to lower time frames. So right about here is where I would create the first zone, given all these wick projections, and then you have that little support area being formed here as well. As we get closer to 1800, you want to be very careful as we're tapping into this zone right about here. So I'm trying to encompass all these wicks, and then also where we're kind of making that rejection into that zone already and kind of pulling back to close the week, which we already have. And then you also have the 1900 area up top here. So those are the 3 zones, and then you can adjust them as you drop down to lower time frames. So now we're going to take a look at the monthly. So on the monthly, last month we closed like a doji, which is showing us clear signs of exhaustion. So all these sellers got rejected down here, pushed back up, tapped into previous monthly highs right up top here, but still closed like a doji. This month we made that top wick rejection into the same exact area. So you could create a line there, a horizontal line. As we drop down to lower time frames, we're going to start to see consolidation around these areas. Let's do 1840. Yeah, 1840 zone. We'll keep it at that. And then we already made that top wick rejection. We're trying to push back down. And this week we closed right into that zone right about here. So we know that in this zone, essentially, it's a no trade zone. If you're looking for any position or swing trade opportunities, you could look for some scalp opportunities, but you need to wait for that 1800 area to be broken if you're going to look for any swing buys. Again, coming back, and actually, let me adjust it back to, I'll do 1835. So if it pulls back up above 1800, you could target 1835 area. And then if it goes any higher than that, then obviously it would be like 1860 and then 1900. But if price breaks below the zone here and continues down, let's say below 1780 right about here, and then continues down, then you can target the 1680 area, this entire wick fill, as a swing trade opportunity. But obviously you'd be taking partials along the way. So this week we closed right here. We pushed back up. All these sellers rejected down here, closed bullish on the weekly time frame, started pushing back up here, tapped into another zone of liquidity where you have all this support being formed, wick rejections, all of that. This week we started off with barely a top wick rejection and massive sellers pressure coming right back into the zone here around 1780 area, closing right into the zone. So now some of the key things that you could ask yourself is, we obviously know that 1800 is a key area, right? We see a lot of fake outs happening around here. We see support resistance being formed. We see wick rejections. So did we just push back up here, create that resistance, and this bearish move down was simply a correction of this entirely bullish momentum? Or are we still trying to consolidate into these areas, grab more liquidity as more fundamentals start to come out, and then finally continue pushing bullish? Another key thing to note is whenever we do break out of this bearish structure from the weekly time frame, which is going to be above 1835 area, whenever we do break out of it, we need to see a break and retest on the 4-hour or daily time frame in order for us to continue bullish. This is a bearish structure from the weekly time frame and down. So we need to see a clear break and retest above these areas before we look for swing buy or sell buy opportunities. And then sell opportunities would be below the zone here as we continue down. So there's a couple of different things that pretty much happened here. The first thing is, are we just simply correcting this entire bullish momentum to the upside right here, creating support, and then continue pushing bullish, which again, we would need to see some sort of break and retest around 1835? Or are we going to continue this entire bearish structure and then push right back down? And all we did was pull back up, grab some more liquidity after respecting the highs, and then continue back down to revisit 1680. So for that bullish momentum, obviously we need to see more market fear, whether that's geopolitical tensions, whether that's macro fundamentals from the global economy, or from the US dollar in this case, since it is gold versus the dollar. And then for a push down, we need to see more economic growth happening. We need to see more positive sentiment coming into play. On the daily time frame, now we broke below the 1800 level. We start to do some sort of a break and retest. So if we're dissecting the candles here, we just made a massive top wick rejections right into that consolidation area up top here. We just grabbed liquidity and then closed bearish without making a bottom wick rejection, which tells me that when this daily candle closed, there was a lot of bearish momentum in it. So the following candle, what we need to see happening is, notice we also didn't break the lows here yet. So the following daily candle, what we need to see happening is either another top wick rejection and then continuation down. As it breaks the low here, which is around the 1780 area that we're talking about, then you can look for clear sell opportunities coming down, obviously targeting some of these minor levels based off the 4-hour, hourly, or even the daily time frame as your partials, and then look for your final TP as we get closer to 1680. So you could look for a final TP either right into that weekly or that daily support area at around 1730, or you could wait for that entire wick fill. Personally, for me, I would start looking for partials somewhere around here and then take majority of my trade out as we tap into 1730 and let the rest of it run to go and fill the wick. If I'm looking for sell opportunities, which again, just simply look at structure here. So simply
Well, I think that begs the question, is there anything in this that has you looking at it buy side?
Not yet.
Now that we've talked about all this stuff, yeah, okay. So fundamentally, technically, sentimentally, is there anything that has you looking at buys?
Nothing yet.
Okay.
From a technical perspective, we're pushing on the daily time frame. We're bullish. We closed bearish right here into the zone, and we're starting to make some break and retest. The only time I'm going to start looking for sell opportunities. So right now, I'm not even looking for sells or buys because we're not in any of those clear areas just yet. For me to take a clear sell opportunity, I need to see this entire area here being cleared out. That means the following daily candle breaking these lows and then also breaking below the support. And then I can start looking for partials around this doji, which shows me that on a lower time frame, there's definitely a lot of uncertainty in this candle. So maybe some like 4-hour candles creating or breaking top and bottom wick rejection, showing me some uncertainty in market sentiment in general. So I could take some partials as price drops below 1850 area and then, or 1750, sorry, and then continues down to 1730 and then let the rest run for 1680. So as you can see, we just broke that bullish structure, did a break and retest right here. Now we need to wait for the following candle to continue down. From a fundamental perspective, this means that they're going to start pushing out some more positive sentiment. This could mean tapering, right? They could start talking more about tapering, which is hyping up a lot of investors. That's what investors are looking towards as a positive sentiment for the US economy. But obviously we know what the consequences for that is going to be. So that's another thing to watch out for. And that's why we're going to be targeting some of these areas down here, because as we tap into some of these key areas on a higher time frame, that's simply a correction of the bullish momentum. And then if we're going to look for any buy opportunities, then clearly we need to wait for that 1835 area to be broken. Now let's drop down to the 4-hour time frame, and this is the lowest that will go. So a lot of sellers pressure to the downside. We start to consolidate here a little bit, but even in that consolidation, we are continuing to make lower lows and lower highs. So you got that first high, pushes back down, creates its first low. You got your lower high, continuation down with a lot of sellers pressure. You got another low being formed here, push back up, respects 1800, continues down, creates another low. And then we start to push right back up after rejecting all these sellers down here. Push back up, still tapping into previous highs, which is the 1800 area. You get a little bit of a fake out and then continuation right back down. So this bearish momentum still has to be corrected. And we know that there's only two ways, right? Either a retracement or consolidation. So Sunday market open, I don't really expect much to happen unless there's macro fundamentals that are coming out over the weekend. So I don't really expect much to happen, but I'm going to wait for these areas here to be cleared out before I look for any sell opportunities, and any buys would have to be above 1835. So for GJ, let's start off with the yearly time frame. I'm going to mark off the level that price made a top wick rejection into earlier this year. So let's say 156,200, right into that area. I'm also going to mark off this level right here, which price has been respecting as resistance. And it seems like we try to push above, tapped into equal highs from about 2018, came back and closed right at this resistance area here again, which is at 152,200. So as we drop down to lower time frames, I'm going to make this red. So as we drop down to lower time frames, the red is pretty much going to tell us that this is the yearly time frame level that we're watching out for. Another thing that I'm going to mark off is going to be the support area right about here. So as you can tell, even on the yearly time frame, we have been consolidating in this range between 139, let's say 139 or 140 flat, between 140 and 152,200, right? So that's a pretty big range. So obviously you could look for swing trade opportunities. You could look for a lot of scalp opportunities. But on the yearly time frame, we have been consolidating in this area for a very, very long time. So now as we drop down to the quarterly, so last quarter, we closed bullish above 152,200, which was a pretty good thing. And this quarter, we didn't even try pushing bullish, right? There's barely a top wick rejection right here, barely a top wick rejection. And then after that, we came back and we closed right below 152,200 this week. And as you can see, this is the last month of this quarter. So you want to be very careful because this quarter we've already come back down and tapped into previous resistance areas of 154 or 148,500. So previous resistance areas right about here. So that's another thing that you want to be very careful as you're approaching 148,500. So this entire area is sell opportunities that we're going to be watching out for. Anything above 152 is going to be buy opportunities leading up to 156,200, which we know is also another key area from the yearly time frame. Another thing to notice is even on the quarterly time frame, that's insanely bullish momentum to the upside, right? After price respecting this area of support for a very long time, for many quarters, and then even to the left, this was resistance, support, a little bit of a fake out right here. So that's a lot of bullish momentum that has yet to be corrected. From a fundamental side, that obviously means that the pound has to be weaker than the yen. So same thing.
Sorry, can I ask you a question real quick?
Yeah.
Like you know, I know that this pair is typically very trusted. You know, the yen is obviously a safe haven that people tend to go to. But with back to our earlier conversation, both of these economies are sputtering. They have a lot of pressure in them. They have COVID rage and all this stuff. If you go back to the 3-month look like you had, they're both dojis. So for the last like 2 quarters in a row, it's been kind of stalled out, right? The window for which to trade is really tight. So what would you suggest going down to the monthly and weekly? What would you suggest we look at outside of the chart to note whether it's going to go more towards the British pound or more towards the yen?
So with both, I'm glad you asked that question. So for both of the currencies, we know that they're both weak in their own ways, right? There's a lot of concerns, investor concerns around both currencies in their own ways. For the pound, it's around the Delta variant, right? It's the same exact thing with the yen as well. And then there's also Brexit, post-Brexit consequences are still going on, right? And then we also have now concerns around the employment, tapering, and all that stuff. The yen is not on that level yet, right? And that's what the deputy governor has already said. They're not even going to talk about tapering. The economy itself is not there. The major concern there is COVID, the Delta variant, right? And so if the pound is able to do much better when it comes to COVID cases, the Delta variant, and then also the post-Brexit consequences, they are going to be there. You're always going to see like those concerns popping back up. But if we can start to see better inflation data, if we can start to see better employment data coming out of the pound, I do think we are going to continue bullish here because one currency only has to be relatively better than the next one, right? And that's what we're looking at. Both currencies are weak in their own ways and their own fundamentals, but I just listed out the fundamentals that we're going to be watching out for. Now you have to kind of understand, okay, which one is relatively better than the next one. And so now when we drop down to the monthly time frame, we're sitting right into these key areas and right into these key zones. So we need to, from a technical perspective, we need to break out of these areas right here. So you're obviously going to have like a resistance zone up top here, but I'm highlighting the overall key zone that we're sitting in right now with the bottom wick rejections, and you have like doji closes. You have one fake out, comes right back down, grabs liquidity, and we start consolidating right down here, and then start pushing right back down. Same thing here. We have one fake out, right? Very similar to what's happened in the past. So now can we expect another maybe candle to come back, grab some more liquidity from this area, and then continue down, potentially tapping into 148,500, and this entire momentum here has yet to be corrected. So either it gets corrected through that pullback or it gets corrected through that consolidation. Now we drop down to the weekly time frame, same thing. So I'm going to encompass this little support that's being formed down here, and then also that resistance up top here. So this tells me that if I'm going to look for any position or swing trade opportunities, I need to see these areas being cleared out. So if I'm going to look for a buy opportunity, this is very similar to gold, right? What we saw on gold, where that was in a weekly time frame downtrend. Same thing here, weekly time frame downtrend, right? So if we're going to look for any buy opportunities, I need to see a break and retest of 152,200 zone, not the level itself, but the zone in general, either on the daily time frame or the 4-hour time frame, and then continuation back up. As it continues above this level right here, which is that previous resistance, then I'm looking for buy opportunities coming up to 156,200. obviously taking partials along the way and then making the trade completely risk-free. If price is going to continue back down, so what I want you guys to notice is this week we closed as a doji, right? So that tells me that there's still not enough bullish momentum for price to continue back up. If next week we can come back and break below this bottom wick rejection from this week, then I'm looking for sell opportunities coming down to around 150 area, and then finally targeting 148,500. Let's drop down to the daily time frame. So on the daily time frame, same thing. You can see there's a ton of consolidation that happens right above and below 152,200. And that's exactly what we've done this week, right? We haven't really broken past these areas. We haven't really continued down. So if we're going to look for any sell opportunities, it will have to be below 151,500. This daily candle right here closed bullish after rejecting all these buyers on the upside. So now are we going to continue above 152,200? And again, that's going to come from the fundamental aspect since we are sitting at key levels. So we need to start seeing some more positive fundamentals from the pound compared to the yen. And that's when we're going to start pushing back up. But we will need to see some break and retest formations here before we continue bullish. And then if we're going to continue right back down, then we're going to wait for 151,500 to be broken. We can drop to the 4-hour time frame and see how there was the same exact fake out that we saw on gold as well. Right, the same exact fake out that we're starting to see. Obviously, there's going to be different variations of it, but just understanding, like I said, the overall picture of what's going on and how is that going to be translated onto the charts.